Friends, I, Captain Vivek Jain, welcome you all to my fifth episode. Today, I shall briefly explain trading and how the equity shares gives all of us earnings. So far, friends, in my earlier episodes, I have explained what is an equity share. We have discussed that equity shares are traded, means sold and bought in a stock market. That place in the stock market is known as stock exchange. Equity shares are traded through a broker, but the price of the shares are determined by the general public, by you and me, by the process of auction, by demand and supply. And we shall discuss this aspect of demand and supply in a bit detail. Friends, here is my presentation. Demand and supply. If the demand for a particular share is more than supply, that means there are more buyers than sellers. The share price by auction will rise. If the demand is less than supply, meaning more sellers than buyers, the share price will fall. It is actually as simple as that. Demand and supply will depend on many factors. There are several factors, and some of them I will show you here. The main ones are quality of the company, the current performance of the company, that is, the earnings and rewards to shareholders that the company has provided so far. What kind of dividends the company has given, what kind of bonus the company has given, what kind of capital appreciation the market has given to the company because of its performance. And those are the rewards which a shareholder definitely looks for. It is quite clear and understood now that the price of the shares of any company will fluctuate daily. And there is no fixed price for it because it is reckoned by the process of auction and it is reckoned by you and me. This fact we have to accept, we have to understand clearly in our minds. Then one may ask, there is such a dynamic and uncertain pricing of equity shares. Why should a common man take risk with his hard-earned money and put it at stake? This is, friends, because if the general economy of any country is sound and growing, if the overall market scenario is good for business and services, if the general public is spending money, then the companies in various businesses will also earn and they will make profits. And who pockets the profits? The equity shareholders, of course, because they are the owners of the company. The shareholders will get the profit in a proportion to their holding the quantum of shares. Someone may hold more shares, someone may hold less shares, and as per the shares, the various profits, the various rewards, the various dividends are declared, and that proportion will automatically be there in the system. At this juncture, friends, let me tell you how these earnings are distributed to the equity shareholders. The company owners are represented by few chosen people. They may be majority shareholders who have commenced the company at the inception. Again, they are chosen by you and me in due course of time because the ownership also keeps changing. And there are other efficient industrialists also who are invited to participate in the company's representation, and that is called the board of directors. All the board of directors need not be shareholders. Some of them can be pure professionals, and many of them can be majority shareholders also. The board of directors who manage the company, who run the company, and they divide the various aspects of running a company within themselves, they regularly meet at different intervals, at periodical intervals, and their purpose and their intention is to promote and grow the business of the company. And any other matter of the company where a major decision is necessary, they again come and meet, including distribution of profits. Now, friends, you have to also appreciate and consider and accept that 100% of the profits are never distributed. Some part has to be retained, some part has to be reinvested in the company. And why? Because the company has to grow for the future growth, for the business development, and maybe for returning loans which may have been taken for short term or for medium term or for long term from any source, from any financial institution, from any bank, for working capital requirement or other necessities, for buying plant and machinery. So they have to be returned maybe partly, maybe fully from the profits of the company. The balance part, after appropriating these mandatory necessities for the growth of the company, development of the company, is distributed to the shareholders, as I said, in proportion to the holdings of equity shares in the form of dividend. This decision and many other major decisions taken by the company's board of directors are circulated to all the shareholders for their approval. When the majority of shareholders approve any decision, that is how it stands. It should then now be understood very clearly that investing in equity shares of any company will provide returns in two forms basically. First, dividends, as I said, which is a portion of the company's profit distributed regularly during the year. And the second is by capital appreciation of the share price in the stock market. This ascertaining of the capital appreciation is done by the auction process, as I said earlier, by general public, by you and me, by a perception of the company. As is mentioned over here also, how the capital appreciation takes place. General perception of traders, investors in the stock market, what kind of growth the company has given, what performance the company is doing, what rewards they have given so far, and what rewards could be forthcoming. All these factors are taken into account, and people would like to pay more for a company. And that is how the capital appreciation of equity shares takes place. You see, this is all due to the fluctuating demand and supply. Now the question comes, what is this demand and supply? I'll give you a simple example. Let's say a house or a residential flat or even a property of similar size and quality will be priced differently depending upon its location and situation in different cities and venues. The same house, the same flat, the same property situated in different places will have different price. This is well known to all of us. And who reckons the current price, the prevailing price? Again, by demand and supply, you and me. Like the example further goes on to say that if you wish to buy 1,000 square feet flat in one city today, it may cost anywhere around between 50 to 60 lakhs of rupees. But if you wish to buy a similar kind of a flat in a city, Mumbai, it may cost few crores of rupees. Why? Again, demand and supply equation, which is again caused by you and me. Now let us come back to our earlier discussion of capital appreciation in equity shares. The original face value of the equity share of a good performing company may be 1 rupee, maybe 2 rupees, 5 rupees, or even some old companies have 10 rupees. It will rise as per the stock market's valuation, as per the auction process of general public, as per the trading which continually takes place, as per the people's decision whether they would like to pay more for the company, viewing into account the company's past performance and future possible performance. And that is what is capital appreciation. When the face value of the share rises and people are willing to pay more than the face value of the share, that becomes the market price of that share on that particular day. And that is the capital appreciation. I will give you some examples over here which are valid for this month, August 2020. A 10 rupee face value equity share of Reliance Industries. Reliance Industries has maintained its own old face value of 10 rupee. They have not changed it. It has reached today around 2,100 rupees. That is 210 times the face value. A 5 rupee face value share of Infosys Limited, which is an IT company, is costing 900 plus today, 180 times the face value. A 2 rupee face value share of Larsen and Toubro, which is an infrastructure company, is also priced today at 900 plus, which is 450 times the face value. And see this, a 1 rupee face value share of SDFC Bank has reached 1000 plus. That is a remarkably 1000 times appreciation, 1000 times the face value. And there are plenty others which you can see in any financial newspaper. All well-run companies, they distribute good regular dividends every year to its shareholders, and the stock market rewards the shareholders with handsome capital appreciation because of the performance of the company. This is a real twin benefit. The capital appreciation is what surpasses the inflation monster. It is normally a good company will have its capital appreciation more than what inflation will be there. And what about regular dividends? We can use it for whatever purpose that we wish. Maybe for our day-to-day, maybe for our monthly, or maybe for any other expense that we wish. It is added income to us apart from capital appreciation. Let us find out through various sources available the dividends and capital appreciation provided by so many good companies listed and traded in the stock market. You can get those sources from newspaper, from media, from the TV, or from any other source. You can find so many good companies are there and what kind of dividends they have been paying over the years, what kind of capital appreciation the market has given them over the past few years. And you will then appreciate and consider and you will understand what twin benefit every company gives. Let us also see and keep in mind that those companies who may not have performed well or rather poorly have depreciated over the years and are not able to offer any dividend probably. Sometimes the company rises, the price is very handsome, very attractive, and then the company's performance starts deteriorating. The company share price also will reflect that in the coming time. It will also start reducing. And then this is what we all have to learn to be able to discriminate between the good performing companies and those that are not doing well. We should not rely on hearsay or ask any Tom, Dick or Harry for tips or advice. This is my strong suggestion to you. We can get suggestions from various other sources also, and maybe many of them are quite sound. But friends, I would like to remind all of you and strongly emphasize that the final decision has to be only yours and yours alone. After all, it is your hard-earned money which is going to be put at stake. It is you alone who shall decide which company's ownership or part ownership, as I said, you wish to rely on. And that is precisely what I'm going to discuss in good detail in our further episodes. So, friends, what do you say? Is it enough for today? Let us sleep over it and keep it afresh in our memories. Our further episodes will show the total capital formation of the company, the business progress, balance sheet, reading and studying and understanding, profit and loss account, and many other financial parameters which we will come across. Friends, if you have enjoyed this discussion, if you have learned something from this discussion, I would request you to please subscribe to this channel. Mark your like and do not forget to post your comments in the space provided. I will try and reply to all of them. See you again and have a nice day.